This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome back to Chapter 3 of Cryptocurrency Chronicles, The Rise of Digital Cash. In this episode, titled Crypto Giants, From Hobbyists to World-Changing Developers, we're diving into the fascinating journeys of key developers and investors who helped shape the world of cryptocurrency. Get ready to explore their stories and insights that transformed a niche hobby into a revolutionary financial landscape. Let's get started. Some of the world's most powerful financial code started as late-night experiments on tiny internet forums. In this episode, we'll trace how a handful of cryptography geeks went from swapping hobby projects to building systems big governments now have to take seriously. By the late 2000s, those forum tinkerers had quietly crossed a line. They weren't just arguing about math anymore. They were shipping software that moved real money for real strangers. Code that once lived in dusty Git repositories began humming on thousands of laptops, then hundreds of thousands of specialized machines, all volunteering to maintain a shared record of who owned what. Early on, most people dismissed it as internet play money. Yet a few developers kept refining the rules, fixing bugs, and obsessing over how to coordinate thousands of anonymous participants without a boss. As their projects survived attacks, downtime, and brutal market crashes, something unexpected happened. Mainstream engineers, financiers, and even skeptics started reading the source code, and some quietly decided to build on top of it instead of tearing it down. Some of those early builders treated their projects like open-source side quests: fix a bug after work, propose an upgrade on weekends, argue in comment threads that only a dozen people read. But as the network survived longer, the stakes changed. Quiet hobbyists became de facto central bankers for systems worth billions. New roles emerged: core devs writing the rules, miners and validators enforcing them, and investors funding risky experiments that traditional VCs wouldn't touch yet. Meetups and cafe backrooms turned into global conferences, and mailing list debates started moving actual markets in real time. When Bitcoin quietly launched in 2009, it didn't look like the seed of a trillion-dollar market. The code was clunky, the interface was unfriendly, and almost nobody outside that tiny circle of enthusiasts cared. Yet block by block, the system kept running. Over years of hostile scrutiny, one fact became hard to ignore. At the consensus level, the Bitcoin network never suffered a successful hack. For software moving billions in value, that track record was unheard of, and it gave skeptical programmers a concrete data point. This strange new machine, if nothing else, was resilient. That reliability turned early experiments into something closer to financial infrastructure. Exchanges appeared so people could swap coins for dollars. At first, they were fragile and often poorly run. Over time, a Darwinian process played out. The sloppiest platforms imploded. The survivors hardened their security and compliance. By 2021, firms like Binance were moving multi-trillion-dollar trading volumes, numbers that placed them in the same conversation as major stock exchanges, whether regulators liked it or not. Bitcoin solved one problem: scarce digital money, but left others open. Developers who'd cut their teeth debugging wallet software began asking a bolder question. If you can coordinate strangers to agree on who owns coins, why stop there? Why not encode whole financial agreements, or even small organizations, into the chain itself? That line of thinking produced Ethereum in 2015, with its programmable smart contracts. Now the ledger wasn't just tracking balances, it was executing logic, enforcing rules exactly as written, without a human operator hitting approve. This shift was less about buzzwords and more about composability. Simple contracts, like a token or a lending pool, could be snapped together into larger projects the way developers stack APIs. That's how decentralized finance emerged: lending protocols that algorithmically set interest rates, trading venues where anyone could supply liquidity, and derivatives built from transparent building blocks instead of opaque term sheets. And because all of this lived on open networks, usage left fingerprints. By 2021, Ethereum was settling transaction value on the scale of Visa, and on-chain analytics showed where the activity clustered. Stablecoins, DeFi, NFTs, cross-border transfers. Data, not hype, convinced heavyweight investors that this wasn't just speculation. It was an alternate financial stack forming in public. Andreessen Horowitz's multi-billion-dollar crypto fund was one of many signals that the toy phase was over. Early Bitcoin and Ethereum apps felt like clumsy prototypes, ugly wallets, glitchy exchanges, half-finished tools. But those rough builds worked like proof-of-concept drills for a city that didn't exist yet. People tried simple things first: tipping strangers online, moving money between countries at odd hours, raising funds for niche projects with tokens instead of shares. Each success pulled in another wave of builders who wanted to stretch the rules a little further. Developers who once only shipped pull requests started spinning up full-blown businesses, custody firms for institutions, analytics dashboards for on-chain activity, infrastructure companies that guarantee uptime so others don't have to babysit nodes. Artists who never touched command-line tools learned just enough to mint NFTs and sell directly to fans. In DeFi, small teams deployed experimental lending markets that, if they caught on, could attract billions in deposits in weeks. Think of it like a new programming language. At first, only purists care. Then suddenly, every startup job post quietly asks for it. Instead of fading into the background, these networks are quietly wiring themselves into everything else. Layer 2 rails chase cheaper, faster transfers. AI agents may soon pay each other for data. Cars could settle parking and charging fees on their own. As real-world assets and even salaries stream on-chain, the boundary between crypto and the economy blurs, like a new operating system gradually taking over critical servers. The open question: who gets to log in, and who writes the rules? The next wave may not look like crypto projects at all. It might be payroll apps that settle globally by default, games where rare items behave more like signed baseballs than pixels, or co-ops that issue membership as liquid, tradable keys. The hobby phase is over. Now we get to see which of these experiments hardens into everyday infrastructure. Start with this tiny habit. When you unlock your phone for the first time each day, tap into your app store and read the description of one beginner-friendly crypto wallet, like MetaMask or Phantom, without installing anything yet. Tomorrow, when you unlock your phone, Google one open-source crypto project mentioned in the episode and skim just the README section on its GitHub page. The next day, when you unlock your phone, open your Notes app and type exactly one sentence about what problem that project is trying to solve. Keep repeating this 3-day loop until it feels natural. This was OwlUp, your daily step forward. This series continues with more chapters on OwlUp.co. Visit OwlUp.co to access the complete course and continue your learning journey. See you there!